What's up guys, it's Paul here from the 95 Investors Club channel. In this video I want to take you back to the basics and show you a very simple option strategy that I use very regularly to make over $1,000 a month at least, just in complete passive income. Okay, now the strategy, a lot of you might already be familiar with it, but the strategy is called a covered call, where you are actually selling call options for a credit with an expectation that the stock would stay below a certain price. Okay, now the way a covered call works is you need to own at least 100 shares of a stock, and then you can sell one call option against those shares, expiring a week down the line, 2 weeks, 1 month down the line, just depends on whatever you choose to. Okay, so I want to give you an example here. So I have 150 shares here of Virgin Galactic at an average cost of $16.32. The way a covered call would work is you would go to trade options, whichever brokerage you use. You would choose, say, a month out. I usually go a month out so I could sell a fairly higher strike price, so let's say March 5th. And ideally the way you want to sell calls is you want the call to actually expire worthless so that you get to keep the full credit that you get. Okay, so Virgin Galactic is at 48 now, so recently they went as high as $58 before coming back down 9% today. So if you still expect Virgin Galactic to stay below $58, for example, in the next 1 month, you could go slightly above that and sell, for example, the $60 call, and you would go select sell here, sell the $60 call, and if you have 100 shares, you can sell one call here, and that will give you a credit of $683. Okay, so this is just one stock where you have 100 shares at least, and you're able to sell one call for $683, which is pretty crazy right there. Okay, now here's the thing. The ideal time to sell a covered call is actually on a day where the stock has actually shot up a lot. Okay, so today Virgin Galactic is actually down 9%. So today is actually not a very good day to sell a call, because as you can see, this particular call actually dropped 34%. So if you had sold this yesterday, this particular call would have been worth probably $1,000. So that's one stock itself where you could sell a covered call and make over $1,000 a month potentially. Just depends on how much the stock has shot up. Also depends on the price of the stock itself, the implied volatility and everything. Right now the IV on Virgin Galactic is extremely high. It's at 187% for this particular call option. Whenever the IV is that high, it really means that the option is very expensive. So that's the perfect time you'd want to sell a covered call and collect that income. Okay, now the like I said, with the covered calls, I told you that you need the stock to expire worthless for you to collect the full premium. So let's say Virgin Galactic did shoot up to $60 by March 19th. The worst case scenario is you actually just get assigned to sell your 100 shares at $60 per share. Okay, so my average cost is only $16.32. So if I had to sell 100 shares at $60, even though I really don't want to because I'm bullish on Virgin Galactic for the long term, but let's say it shot up so much it got out of hand, I have no choice but to exercise my covered call and sell 100 shares at 60, I would still come out with $6,000 plus the $683 in credit that I could initially get by selling that call, and I would be walking away with $6,683 if I were to get assigned on that. Okay, now ideally I try not to do that, because right here, as you can see, I actually sold the 55 call expiring on March 19th and collected a credit of $1051, which is $1,051. Now I need Virgin Galactic to stay below 55 by expiration. If it starts shooting up, I'm not actually going to keep holding it. I'm actually going to roll it over, and the way you would roll it over is you go back to view all options. I choose the March 19th expiration that I have, and I would essentially buy back the 55 call, maybe choose April 16th, so roll it over by another month, and I would sell perhaps the 65 call, for example. I would only have to pay $47 for that, maybe with a difference between bid and ask price. I may end up having to pay $55, whatever it is, but that's a really small amount for me to roll it over to the next month. And now I have room for Virgin Galactic to go up to 65 instead of just 55, and my initial credit would have reduced from $1051 to just $1,000. Okay, so either way, I'm walking away with $1,000 in credit by selling this covered call. And if Virgin Galactic does end up going over 65 and I finally decide, okay, fine, I'm willing to sell it at 65, that's still $6,500 that I'm walking away with, and a huge profit considering my average cost is only $16.32. Okay, I want to show you a few more examples of how I did this, and to give you an idea of how to pick the strike prices. So for Snapchat, I have 100 shares as well, average cost of 22.82. So for this, I sold one covered call for Feb 12th. I actually sold this last month actually, so this is not recent. So when Snapchat was still in the low 50s or something, I sold this 65 call, collected a credit of 216, and now I need Snapchat to stay below 65 by Feb 12th. Now, I didn't expect it to go over 60 already, so let's see where it ends up. I'm expecting that earnings may potentially push it up. So if that does end up happening, I can do the same thing as I did for Virgin Galactic, where I could again go to view options, choose the expiration date here, Feb 12th. I would buy back the 65 call that I have here, choose another month out, say March 12th, go to sell options, or sell call rather, and this time I could sell the 75 call instead and pay only $60 for selling that, for rolling it over to March. Okay, so considering I got a credit of 216. If I pay $70 or $80, that will essentially reduce my average cost down to average credit, down to $130, $140. But that's still okay because now it allows the call to go all the way up to $75, where I would be more than willing to sell Snapchat. Okay. Now another example here is Pinterest. Pinterest also has been on an absolute tear, especially with the earnings coming up. They shot up another 2.8% after hours for a total of over 7%. Just today, I also have 100 shares in Pinterest, average cost of $27.76. In case of Pinterest, I just, again, similar to Snapchat, I sold the $90 covered call expiring on Feb 12th, collected $300. So far, if you actually add it up, I got $10.51 from Virgin Galactic, plus about 216 from Snapchat, plus this 300 that you can see here from Pinterest. So that ends up being a total of 1567 just between these three stocks that I can sell just on covered calls on a monthly basis. Okay, now here's where it gets even better. These are just three stocks with $1,500 a month. Now Magnite, on the other hand, I got this when it was still pretty much a penny stock. I threw $1,000 at it, got 500 shares, but they've shot up like crazy in the last year or two, or 326% in just the last 1 year, but a lot more since when I got it here. So for Magnite here, you'll see that, first of all, I have 5 of the June calls, and I sold 5 March 19th calls as part of a calendar spread. But if you see here, I have 10 45 sells, which basically means 5 of them are part of a calendar spread, and the other 5 are part of a covered call because I have 500 shares. Okay, so if you look at the average cost on these, I actually sold it a little too soon, which is why it shows that I'm actually down on these calls. But the average credit here was 304, and 5 of them were covered calls. So if I do 5 times 304, that's $15-20 right there. Okay, so you add those two, I'm already at over $3,000 a month just selling covered calls. Okay. So this takes time, guys. This does not happen overnight. Obviously, you need to build up enough capital to start owning 100 shares of a stock at least. So it took me a while to own 100 shares of Magnite, and then Snapchat and Pinterest and Virgin Galactic. So I kept building it over time. If you have a smaller account, start with 20 shares at a time. Then when you get another opportune time, get another 20, 30, and eventually another 30 more, and now you're at 100 shares of a stock. Okay, so that's exactly how I'm planning to do it. I have a couple more stocks with over 100 shares that I have been selling covered calls on. For example, Longview is another example here. Longview is a company. It's actually a SPAC that's merging with Butterfly Networks. This is something that I'm actually very, very bullish on for the future. Anyway, so I have 100 shares, average cost of $17.30, and I sold the Feb 19th 25 call here. Collected another 140, so lesser than Snapchat and Pinterest, as you can see. So those are the main examples I wanted to show you guys. Covered call, you need at least 100 shares. As a quick summary, you need 100 shares, and you can sell a call option against it, ideally a month out, but you can also do a week out if you don't want to wait that long. And you can sell at a strike price that is high enough at a point where you're willing to actually sell your shares if you were to get assigned on it. Okay. Now, the chances of it getting assigned are pretty low as long as the stock stays below the strike price itself. So if it stays below the strike price, then the call will expire worthless and you'll get to keep the full credit. So that's the goal. So Longview is only at 1948. That's why I decided to sell the 25 call, which is still a long way away from where it is right now. And there's only about 2 weeks left for it to go from 1950 or 1948 to 25. Okay, and considering my average cost is only $17.30 that I showed you before, I don't mind selling out at 25 if need be. Okay, so that's all I wanted to share with you guys here today. Make sure you add covered calls to your watch list. This is literally like getting a monthly dividend on a growth stock, if you think about it, because this 140 per month on Longview, it could be literally every single month, and for an entire year, that's over $1,600 on pretty much a growth stock. Okay, so if my net investment was $1,730 and I'm getting over $1,600 per year, almost like a dividend just on covered calls, that's almost like getting a 90-100% dividend paid out to me on a monthly basis. Okay, same thing with Snapchat. My average cost was $22.82. I paid $2,200 or $2,300 for 100 shares, and if I'm collecting 300 per month, that's a total of 3,600 per year in just covered calls approximately. Obviously, the credit is going to change depending on when I actually sell it, but that's almost like getting paid 150% dividend on a growth stock, because it's the covered call is being credited to me every single month. Okay, so if you're not familiar with this, be sure to add this to your toolkit, guys. It's very, very powerful. As you grow your portfolio from 4, 5, 6, or even 7 figures eventually, just covered calls can easily make you 4 or 5 figures a month, and it's the truest definition of passive income that I can ever think of. Okay, I hope this helps you out, guys. Please do smash the like button if you enjoyed it. Leave a comment below if you have any questions, and be sure to subscribe if you haven't already, and hit that notification bell. Okay, thanks again for watching, and until next time.